Hi, I'm Anthony Diosdi. I'm a tax attorney in San Francisco with over 20 years experience in international and domestic tax planning and tax litigation. You can find me at sftaxcounsel.com. Today I'm going to be talking about Schedule E and E1 for the Form 5471. Now, this is an incredibly complicated form and it gives tax return preparers all kinds of issues. The purpose of today's discussion is to kind of provide the preparer of the Schedule E with an overview of the general rules which govern this form itself. And hopefully what you'll get out of this presentation itself is if you're having a hard time preparing it, it'll maybe give you some overall guidance on how to prepare the form itself. And hopefully if it will also kind of pinpoint out areas where if you're having difficulties preparing it, if you think you're going the wrong way, it'll provide you some guidance. With that said, when you're preparing this schedule itself, the very first thing the schedule asks of you is to state the type of foreign source income that should be disclosed on the return. So you're going to have like a category under the small letter A. Now, the instructions for the Schedule E do not provide any instructions regarding the type of income or the codes that should be entered after that little A. So what you're going to have to do is actually look at the instructions for the Form 1118. The Form 1118 provides instructions as far as the categories of income that needs to be disclosed on the Schedule E. I will say to you that the vast majority of the time, you're going to be entering Gen under general income for this form itself. Most of the time, general will be what you're going to be disclosing on this formula. General is if you're dealing with guilty income, um, most forms of subpart F income, but not all, or if you have a reclassification of a type of income, then it's going to be disclosed under this general income. I mean, it's a little counterintuitive because you would think that it would be disclose under guilty, but the instructions specifically say don't enter under 951 cap A. I think that's a mistake in the instructions, but nonetheless, that's where you're going to be living when you're doing the Schedule E. Now, if you're dealing with passive income, let's just say you have a foreign corporation that has rental income and it's passive, then you might wind up disclosing under the passive income category, which is capital PAS. In the unlikely event that you're dealing with treaty income, you're also going to have to go ahead and make the appropriate disclosure for treaty income. But most of the time, it's going to come under general. If you're dealing with a foreign corporation that is receiving income from a sanctioned country such as Sudan or North Korea, the very unlikely event, then you're going to have to disclose that on line small capital B, and you're going to have to disclose the country code. But that's going to be a very highly unlikely event. So when we go through the parts of the Schedule E, let's go through part one. So part one, we're going to talk about is taxes which foreign tax credits are allowed. So whenever you're dealing with a foreign corporation that has paid taxes or accrued taxes, you're going to be disclosing this under part one of the Schedule E. In order to save time, I'm going to go through the most important columns here. So column C, you're going to be disclosing unsuspended taxes of the foreign corporation. What is unsuspended taxes? Well, in order for us to understand that, we have to look at Code Section 909 of the Internal Revenue Code. That's Code Section 909. And what this code section says is that if a payment was made for a foreign tax, but for some reason there is an accounting difference between the United States and that foreign country where the foreign corporation is located, or there is a discrepancy because of transfer pricing, or for whatever reason, and if for whatever reason the foreign tax itself wasn't paid or accrued in the CFC's tax year, then that tax amount is going to wind up becoming suspended. And then later on, when it's accrued or paid in the foreign country, that is when the foreign tax becomes unsuspended. So when you're dealing with that situation where the foreign taxes paid in the foreign country was unsuspended, you're going to be disclosing that under column C for part one. Now, column D, don't forget to enter the proper two-letter code for the foreign country in which the foreign corporation paid the tax. For column E of part one, now we're talking earlier about accounting discrepancies between the United States and the foreign country. If there is an accounting discrepancy, you're going to wind up disclosing that accounting discrepancy under column E for part one. And another important column is going to be column K of part one. And why is this important? Because you're going to be disclosing the exchange rate translated into dollars for the foreign taxes that are paid under column K. For column M for part one, this is where you're going to be disclosing the foreign tax that is paid in the functional currency of the foreign corporation or CFC that's reporting to the IRS. What is functional currency? Well, it's typically going to be the US dollar. But let's just say the CFC's books and records are in a foreign currency and it's conducting its transactions in a foreign currency. In that case, the foreign currency of the economic environment of the CFC is going to be disclosed in part one under column M. So now, since we've gotten through part one of Schedule E, or at least the important, most relevant parts of part one, let's move on now to section two of part one. And basically, what section two, part one is going to have you report as the preparer of Schedule E, it's going to be any kind of deemed taxes that are paid to a lower tier foreign corporation. So if you have a CFC that has lower tiered foreign corporations that, let's just say that lower tier foreign corporation wound up paying taxes to a foreign country, you're going to wind up reporting under section two for part one. Now, the most important section is going to be under column D. And column D, I'm going to talk about a little bit more in detail a little later on in this presentation. But column D basically asks you to disclose the previously taxed earnings and profits, or PTEP as it's known, of the lower tiered foreign corporation um, onto the column D. And there's a number of different categories here. And the categories itself are outlined pretty well in the instructions for Schedule E. And we're going to be going through these different categories in a minute. So I'm not going to waste time going through them. But in any event, when you have a PTEP, which is distributed from a lower tier foreign corporation to the reporting corporation, that's where you're going to wind up reporting, and you're going to wind up reporting under column D. All right, part two. Now, part two is a little confusing because part two is entitled election. So when you're looking at it, you're probably wondering, well, what is a part two election? If you look at the instructions, it talks about making an election for section 986A1 cap D. So what is this? So typically, when you are converting a foreign currency to a US dollar, what has to happen is at the end of the year, you basically have to take the average rate of that foreign currency and convert it to US dollars. But what the IRS allows a foreign corporation to do, and in some cases it might wind up working out better, is it allows the foreign corporation to make the election to translate the foreign currency into US dollars on the date the foreign taxes are paid. So if you're making this election would be done. You have to check the box to make this election under Part 2. Part 3 of Schedule E is entitled Taxes for which the foreign corporation's foreign tax credit is disallowed. All right. So We talked earlier a little bit about suspended and unsuspended taxes, and we also talked earlier about if you have a foreign corporation that is receiving fund or receiving income from a sanctioned country such as Iran, North Korea, or Syria or Sudan. So the importance of receiving income from a sanctioned country is that any foreign taxes that are paid are going to be disallowed for US purposes. So if that winds up being the case, that if you're dealing with a foreign corporation and it's receiving income from a sanctioned country under column C, you're going to wind up stating the amount of foreign taxes that were paid to the sanctioned country, and it's ultimately going to wind up being disallowed for the calculation of the US tax liability. There's a number of other situations where you can wind up having a suspension. We discussed earlier about when you have an accounting discrepancy and so forth. So if you wind up having that, you're going to wind up reporting that under this section of Schedule E. Now, where most foreign corporations or preparers of the Form 5471 for foreign corporations have the biggest problem preparing is on Schedule E-1. Schedule E-1 is similar to Schedule J. It's similar to Schedule P in that it requires you to kind of have an understanding of the PTEP ordering rules and Code Section 959. And we discussed earlier how you have to report the PTEP for a lower tier foreign corporation. So let's kind of go through these PTIP rules so we all understand on how to go ahead and properly report the PTIP when you're reporting it from a lower tier foreign corporation and how you're reporting it for purposes of Schedule E-1. And then we'll go through each and every single column and we'll also go through the lines as well. We'll go through this line by line because this is probably the most complicated part of the Schedule E is the preparation of Schedule E-1. So to kind of have a good understanding on how the PTIP rules work under 959, we have to kind of take a look back before the Tax Cuts and Jobs Act were enacted in 2017. And if you were preparing Form 5471s, particular Schedule J, they didn't have a Schedule E on the Form 5471 prior to 2017. The only real knowledge that you had to have regarding the ordering rules for Section 959 was three. You have to understand three basic categories of income for purposes of the 959 ordering rules. And the first was under Code Section 959 C1. And basically, if you had any kind of income that was previously tax earnings and profits that was attributable to an investment in U.S. property, it wound up being reported under 959C1. And we'll get to what an investment in U.S. property is in a minute. Then you have to know how to report PTIP that was attributable to Section 959C2. And what PTIP attributable to 959C2 was any kind of income attributable to subpart F income. What is subpart F income? That was your, and still is, your anti-deferral rules. You had foreign corporations at one time, they were able to kind of go ahead, earn E&P offshore, and as long as there was very creative ways to hold that money, there was no taxes on that offshore income until it was actually repatriated to the United States. And subpart F income was designed to kind of tax some of that offshore income. Now, then there's 959C3. And what 959C3 is, that was your general current income and your accumulated E&P. And if something came under 959C3, that was typically your taxable income. And it kind of remains that way today. All right, so as I was alluding to earlier, the Tax Cuts and Jobs Act of 2017 changed the rules. And what the Tax Cuts and Jobs Act did in 2017, they added a number of types of foreign income, a number of different ways that the Internal Revenue Code taxed or disallowed deductions for foreign source income. And What you now have to do when you're preparing the Schedule E1 is kind of include these different types of foreign source income or disallowances in some cases of expenses into a PTEP for purposes of 959C1 and 959C2. Now, there is some good news to this. And some of the good news is that a lot of the categories that you're going to find on Schedule E1, you're never going to have to worry about completing. And that's because for some reason, the IRS, when they put together these forms, really made a big deal about basically attributing foreign source PTEP into categories that come under US source income or investments in US property. And what is investments in US property? Well, that's going to be defined under Internal Revenue Code section 956. And basically, what an investment in US property is under section 956, the most common way that we're going to see it is if you have a foreign corporation that lends money to a shareholder. That, for purposes of 956, an investment in U.S. property, if there's a loan from the foreign corporation to a U.S. shareholder, it's always going to be an investment in U.S. property, and it's also going to be taxed. Also, if the foreign corporation goes ahead and does a guarantee for somebody in the United States or makes a loan to a U.S. person, probably going to be U.S. source, should say, it's probably also going to be an investment in U.S. property. If the foreign corporation has any kind of holdings in intellectual property, that's also going to be investment in U.S. property. All right. But for whatever reason, the IRS went ahead and they set aside a number of different categories for investments in U.S. property. And because of guilty, and I'm not going to discuss guilty in this video. I'll probably make another video on guilty. But the way that guilty works is it kind of disallows deferral. So whatever subpart F income can't defer, guilty kind of takes care of. So it's very difficult to go ahead and be able to defer income in U.S. property, if not impossible. Now, for purposes of 959C1 and 959C2, there are now a number of different types of income that you have to report. And now you're also going to have to report, rather than just investments in U.S. property under 959C1 and subpart F income under 959C2, you're going to have to basically report guilty inclusions. You're going to have to report 245 Cap A hybrid dividends. You're going to have to report Section 1248 PTIP as well. You're going to have to report 965A income, 965A PTIP, and 965B PTIP. All right. Now, the good news is 959C3 remains the same. So for purposes of adding these additional sources of income or disallowances of deductions, you're going to have to basically put this under 959C1 and C2. The good news, to make it easier, is that you're probably not going to see a lot of 959C1 income invested, PTIP should I say, in U.S. property because of the fact that you just don't have a lot of that because of the way the guilty rules and the subpart F rules work. So when you're going to be adding in these other sources of income and these other disallowances, most of these are going to wind up being reported under 959C2. All right, so hopefully that kind of makes it a little easier when you're actually looking at the Schedule E one, when you're actually going ahead and you're reporting your income under the appropriate columns. All right, so now without further ado, let's go through the columns and let's kind of discuss where these PTIPs are going to wind up being reported. So let's start with column E1 and E6. This is where you're going to disclose your 965A PTIP. What is 965A PTIP? That's a transition tax. So if the corporation itself, the CFC, has been in existence since 2017 or before, what happened was in 2017 or 2018, if the foreign corporation had E&P outside the United States, earnings and profits that weren't taxed, those earnings and profits had to be repatriated. And as those earnings and profits are repatriated, you want to paying a transition tax. Both the foreign corporation, the CFC, and the US shareholders did. And that was reported under Section 965A. So if the foreign corporation wound up paying the transition tax, you're going to have a 965A PTEP. What is a PTEP? Previously taxed earnings and profits that were attributable to the transition tax gets reported under column E-1 if the 965 PTIP is attributable to an investment in U.S. property. If it's not attributable to an investment in U.S. property, it's going to be reported under column E6. Most likely that's where you're going to wind up reporting it if you're dealing with a CFC that has been in existence since prior to 2018. For column E2 and E7, this is also going to be dealing with the transition tax. But in certain cases, you had a group of related foreign corporations. And for purpose of the transition tax, under section 965B, you're able to offset the E&P of one corporation against the E&P of the other corporation, foreign corporation, should I say, and then you'd wind up having a 965B PTIP because of that offset. So if you have a 965 previously taxed earning and profit under 965B that was related to an investment in U.S. property, that goes under column E2. If you have a 965B PTIP that was not related to a U.S. earnings and profits or U.S. investment, should I say, it's going to go into column E7. All right. Column E3 and E10. This is basically when you have subpart F income. So if you had subpart F income and you paid taxes on subpart F income and you had a PTEP generated from that, and it's related to an investment in U.S. property, it comes under column E3. If it was not related to an investment in U.S. property, then you're going to wind up reporting it under E8. All right. Same goes as well for E4, and if you had a PTEP that was related to 959 Cap A guilty, then you're going to wind up reporting it under the appropriate columns. The next one is going to be column E5. And then you can also have the same for E5 as you can have its related reporting if it's not attributable to U.S. property under E9. So what is this? What this column itself is kind of confusing, and I get a lot of questions about these two columns, and let's talk about it. So let's start with column 5, and then column 9 is almost going to be identical, but it's not related to U.S. property. But if you have PTIP that was attributable to a hybrid dividend, then you're going to have to report that PTIP itself under column E5 or E9. Now, what is a hybrid dividend? The best way for us to describe what a hybrid dividend is for us to first talk about Code Section 245 Cap A. And what Code Section 245 Cap A says is that if a CFC is paying out a dividend for earnings and profits from a foreign country, then there's 100% deduction, deemed dividend deduction for that income itself that foreign source income dividend that's being paid to its US shareholders. But in order for you to take this, you're going to basically have to pay taxes in that foreign jurisdiction. So if in that foreign country that the dividends is originating from, there is some type of a benefit or some type of a deduction in that foreign country, then 245 E2 will disallow that 245 cap A deemed dividend deduction. Really, what the Internal Revenue Code says here, they don't allow double dipping. So if the foreign corporation wound up taking advantage of this code section, right, and it was for some reason disallowed because there was a benefit in the foreign country, then you're going to wind up having a PTEP. You're going to wind up paying a certain amount of taxes on that. That amount of PTEP associated with that 245 E2 disallowance will come under these two columns. Now, there's two other events that have to be reported under these two columns. And once again, this depends on whether or not it's attributable to the US investment, which it probably will not be. But the two other reporting events that come under these columns is going to be first under section 1248. Now, 1248, we have to kind of think of it this way. Let's just say you have an individual US shareholder. They have stock in the foreign corporation. They sell the stock. When you sell foreign corporate stock or CFC stock, it's a capital asset. It's subject to preferential capital gains treatment, right? So in order for a shareholder of a CFC not to benefit unreasonably through being paying lower taxes in the form of capital gains, what 1248 does is that it recaptures dividends that have not been distributed. Now, we're thinking now after 2017 Tax Cuts and Jobs Act with the enactment of GILTI by Congress, how is it possible that we could have a situation where there is dividends that have not been paid out that's subject to 1248? And what 1248 does is when there's a dividend that has not been paid out, it's subject to ordinary income. And there are three areas that are going to jump out where you're going to wind up having E&P of a foreign corporation that has to be recaptured under 1248. And the first is going to be, it's going to be under GILTI. And how is it going to be under GILTI? Well, under GILTI, there is a QBI carve out. And what it says that up to 10% of GILTI, because of this QBI carve out, is not subject to tax. It's not subject to the GILTI tax, should I say, or it's not subject to tested income. So if there's an amount that has been carved out and it's not, and the shareholder's not paid taxes on it, that's going to be sort of like a built-in dividend event that has to be paid out under 1248. Another event would be under section 962 of the Internal Revenue Code. And what 962 allows is the individual shareholder can elect to be treated as a foreign corporation for purposes of a distribution from that foreign corporation on that foreign source income. Why is this advantageous? Because the shareholder who makes the 962 election is taxed at corporate rates, which is quite a bit less. It's subject to a tax liability of 21% rather than up to 37%. And if it's GILTI, you're allowed a 50% deduction, which could bring the tax liability down to as low, in some cases, 10.5%. And then if you have foreign tax credits under 962, you could wind up paying little, if any, taxes, at least on the first go around. Now, when you make a 962 election, you have a second tax consequence that hits later on when you sell your shares for any undistributed earnings and profits that come because of the fact that you wound up being taxed as a foreign corporation rather than a US shareholder. So if you made an I-62 election, 1248 will probably apply to you when you go ahead and you sell your shares if you have not recognized that tax liability. And then finally, under certain circumstances, when you made an election under 954 under the high tax exception, there is a chance that there could be some undistributed earnings and profits that have been deferred. So that would also wind up being bought in under 1248. Then in other circumstances, you could have a triggering of a 1248 event if you have a group of foreign corporations. And let's just say, as a result of subpart F income, there's a triggering of a tax consequence on the sale of the shares because there was an event that one of the corporations itself is deferring foreign source income. So you could wind up having a triggering event under 1248 in a situation where a foreign corporation is selling shares in another corporation. That's also a CFC. All right, so I think that's going to end our discussion on the columns of E-1. So let's kind of quickly go through the lines of E-1, and there's 14 different lines, and the first line is line 1A, and basically line 1A, as a preparer, you're going to wind up entering the balances of each column at the beginning of the year. And those balances itself, when you're starting your reporting event, they should wind up equaling to what was reported in the previous year. So under line B2, if there's a difference between the reporting from the previous year to this year, after adding up your columns, then you're going to have to go ahead and explain that difference under line 2B. You're going to also have to have an attachment because it's not going to be enough to report that difference just on line B1 itself. So there should be an attachment to the schedule E1 explaining that difference. So for line 2, basically you're going to go ahead and reflect any adjustments to a U.S. person's foreign tax credit as a result of amending a prior year's return. So if there is an amendment that reports a difference in the foreign tax credits paid to a shareholder, line 2 would have to be completed just as with line 1B. An attachment should be done to the schedule E1. For line 3A and line 3B, this is going to be similar to what we discussed earlier about any kind of suspended taxes. So if you have suspended taxes or unsuspended taxes as a result of accounting differences or as a result of transfer pricing or differences in jurisdictional recognition, then this is going to be reported under lines 3A and 3B. Line 4, you're just basically going to go ahead and add up your columns up to line 5 and then make that adjustment or basically add up those numbers. Line 5, if you're dealing with a merger and acquisition, and if you're dealing with or an asset sale from another foreign corporation, so any kind of carryover taxes from a foreign surviving corporation or any kind of acquisitions of an asset from a foreign corporation that has taxes that were carried over would be disclosed under line 5A. So I'm going to skip ahead now to line 7 because line 5 and 6 are self-explanatory. Line 7 is basically going to be any kind of adjustments as a result of a PTEP that was distributed from a lower tier foreign corporation would wind up being reported under line 7. I'm going to jump ahead now to line 9. And basically, if there's any foreign taxes that were paid that were deemed inclusions as a result of subpart F income, would wind up being reported there. Under line 10, any kind of taxes that were deemed and paid and distributed as a result of the corporation's E&P would be reported on line 10. Under line 11, if you had any kind of reclassification from 959C2 to 959C1, you'd wind up reporting it here. So if you had a reclassification from any kind of a PTIP that was not related to an investment in a U.S. property that somehow got reclassified because it is now the investment itself is really the PTEP itself is related to an investment in U.S. property, you're going to wind up reporting that on line 11. And if that wound up taking place, then any kind of adjustments as a result would wind up being reported on line 12. And then for the final lines for 13 through 15, you're basically going to be just disclosing any kind of adjustments as a result of guilty or any kind of adjustments as a result of taxes that were paid. Okay. It should be obvious that Schedule E is not an easy schedule to prepare for purposes of Form 5471. If you have any questions or if you have any doubt regarding the preparation of this schedule, seek the advice of a competent professional who understands this schedule and understands the Form 5471 in general. As always, this discussion is not meant as an invitation for legal services. This is meant for informational purposes only. If you found this discussion to be informative, please check out my other videos on the Form 5471.